Good afternoon, everyone, and welcome to this month's webinar, Insurance Planning for Clients in Their 20s. The presentation part of today's webinar will last about 50 minutes, plus some time for Q&A. And we love questions, so feel free to ask them on screen throughout the presentation. We'll do our best to answer them timely, and then at the end of the presentation, we'll open the phone lines for verbal questions as you raise your hands on the screen. This webinar is being recorded and will be posted to our website within a week. And regarding CFP-CEs, if you're logged onto the webinar today for more than 50 minutes, we'll report your attendance to the CFP board. That process can take about up to a month. Now, if you were with us last month, you learned that our webinar series this year will take us through the lives of one couple, Sam and Sally, through the ages. This month, they're in their 20s, and we'll follow them through to the end of their policies, the end of their lives, and the end of the year, December. Each month, we'll focus on an age range and the types of insurance appropriate for your clients in that stage of their lives. Today's presenter will walk you through why term insurance is needed for your clients who are 20-something. And the ages we'll present throughout the year with the solutions for Sam and Sally are general in nature. In other words, term insurance is a good solution for clients in most age ranges, not just for 20-somethings. And now about your presenter. You may know him as our annuity go-to guy, but Jerry Skapyak is also the main point person for most of your clients' term quotes. He's been in the insurance industry for 20 years, handling product development and intelligence analysis for 2 top-rated insurance companies, and with us since 2008. He is a vice president in our advisor services team and is an expert at assessing clients' needs and the benefits most important to them to tailor the right product for their unique circumstances. And now, to present insurance for clients in their 20s, I give you Jerry Skapyak, who is desperately trying to get back to his 20s.
Thank you, Dina. All right, trying to get our slides to advance here. All right, today we are going to talk about term insurance for clients in their 20s. What we're going to look at the basics of term, designing term, some unique templates for each client, how to turn an inefficient asset into an efficient protection. We'll look at group term and see if it's cheap, how it is cheap, but is it the cheapest option for your client? And we'll look at some term riders. So first we're going to take a look at the basics of term. Your client's biggest asset they have when they're in their 20s is themselves, their ability to earn an income. We're going to look at why it makes sense for them to buy it young. We'll look at different bands and minimums for term insurance. We'll also take a look at some of the underwriting classes that are available. So what we're looking at here is what we refer to as an insurance pyramid. The foundation for your planning is based on your client's ability to create an income. So everything you're doing for your clients depends on them being able to earn an income. All the projections you do for savings and retirement, all that is dependent on them making an income. And it's often forgotten that what if that income is not there? Well, we help protect your clients with life insurance and disability insurance. And in fact, in May, Kathy Kopak will be doing a webinar on disability for insurance for clients. Even though it's based on, in our webinar series for clients in their 30s, there is no reason why they cannot look at it in their 20s. So your client's biggest asset is their ability to earn an income. They don't have many assets to protect in their 20s. Their net worth may be maybe $10,000 if they're lucky, but their earning potential may be tens of millions of dollars. Just look at it this way. You can't make a house payment without a breadwinner bringing the money in to pay for the house. So what makes term attractive for clients in their 20s? Well, they're able to get a fixed guaranteed death benefit, and they're able to get a fixed guaranteed premium. And those premiums, when they're in their 20s, are extremely low and can be guaranteed for up to 30 years. Also, by getting insurance when they're young, we're able to guarantee their insurability. There are a variety of different underwriting classes which determine the premium costs for your client. It could be a super preferred, standard plus standard, down to tailored ratings. We're going to go into each of these more throughout the presentation. So quite often one of the first questions we're asked is, how much is term insurance? Well, what this is, we're going to look at Sam and Sally here. Sam's 28 and he needs $2 million worth of insurance. If you notice here, we have all the term periods that are available, and if he's preferred plus, it starts out at $480 and goes up to $1,240 for a 30-year term. Why does it become more expensive as the term periods get longer? The reason being is that the most expensive part of a term policy are the last few years of insuring that client. So that's why we see the premiums going up. And also, we'll notice that the premiums go up as we move to the right, preferred plus being the most healthiest of clients, standard being an average client. And you can see for your very healthy clients for a 10-year term of $2 million worth of insurance, it's only $480. If they're in a standard class, that premium goes up to $1,020. Still relatively inexpensive for a client at this age. And then for his wife, Sally, who's also 28, if we're looking at a 20-year term for $2 million, her premium is going to be $800, all else being equal. So with buying this term insurance when they're young, it allows the client to lock in their insurability for the long run. There are possible health changes as they age. As you see with your own clients, your older clients, as they get older, generally have more health problems than the younger clients. We've had clients who have developed MS or Lou Gehrig's disease when they're young, or chronic diseases. They're hard to underwrite as they get older. Most of the time, you don't see clients developing those when they're younger. Lifestyles or occupation changes. We've had a client who took out a term policy who was young and then joined the foreign reserves and was sent to a country that was considered dangerous, and if he wanted to apply before he knew he was going there, he would have been uninsurable because of where his foreign travel was going to be. It's very low cost today, and they can get large amounts of insurance relatively inexpensive. Actually, all the term policies we offer have conversion options. And what the conversion does, it's the cheapest way, may have the shortest conversion options when we're looking at term insurance. Not all term policies are convertible for the full term period. Some of the premiums that you may see out there may only be convertible for the first 5 years of the policy. They're not always guaranteed to the end of the term period. For older clients, generally most policies are convertible to age 70. So for your clients, say you have like a 65-year-old client who wants a 15-year term, probably only be convertible to their 70, so it won't go to the end of that term period. So, but what is a term conversion? Well, it's a contractual right. What it says is that if your client buys a term policy and it's issued at a preferred plus underwriting class, it says during that term period, during the conversion option of that policy, the client can convert that policy to a permanent policy at the same underwriting class that the original policy was issued at. So for a client who got a policy issued at Preferred Plus, they can convert it to a permanent policy at Preferred Plus. Now, they don't have to exchange the whole amount of coverage. If our client had a $2 million policy, they may not want that much of permanent insurance. They can convert generally down to as little as $100,000. They don't have to go through that health underwriting again. They're going to get that same health class that it was originally, the original policy was issued at. They're able, when they convert, it's going to convert, though, at their age at the time of conversion. So if our Sam was 28 when he took out the policy, he wants to convert it when he's 40, he's going to pay the premiums for a 40-year-old for that permanent policy. He'll get that Preferred Plus underwriting class, but he's going to pay the premiums for same as a 40-year-old. As I said, we're normally going to recommend term policies that are fully convertible for the full term period, and also there's no financial underwriting done with these policies. And speaking of financials, at LLIS, we're always considering the financial strength of insurance carriers when we're making recommendations. Our two primary things that we're going to look at is we're going to look at the convex rating of an insurance company. And our standards are that they have to have a score of 75 or better. What the convex ranking does is it looks at all of the different financial ratings the insurance company has received from the various rating agencies, and it assigns a number to them, anywhere from 0 to 100. So a company that has a convex score of 75, we know that they're in the top 25% of insurance companies based on financial ratings. The other factor that we were looking at is we want the company to have an AM Best rating of an A or higher. And if you ever have a question about a company, if we're sending you a term quote, we always include that vital signs report with the term quote. That's generally the last page. Or if you just need to know what the ratings are for any given life insurance company, let us know and we'll be more than happy to send you a report. So super preferred now, what later? Well, your client's greatest chance of getting the best underwriting class is now when they're young. They're healthy. They haven't had heart attacks. They don't have cancer. They don't have generally high blood pressure. They haven't had these health issues come up yet. But as they age, though, those conditions are going to start creeping into our clients' health as they get older. And speaking of age, one of the things with LLIS is we care about the age of the clients. So we have Sally here, whose birthday is June 15th, 1984. Almost all of us would agree she is 28 years old. Well, that is true, she is 28, but when we're looking at insurance companies use either insurance age or age nearest or actual age. So for a majority of insurance companies, though, when they're looking at Sally, she's actually going to be considered 29 already. Even though she hasn't had her actual birthday yet, the insurance companies are going to consider her 29. When they're looking, because most insurance companies are using age nearest, so they're looking at 6 months before and 6 months after her birthday to determine her age. With actual age companies, she's still 28 years old, as how we normally think of ourselves. So why do we care about the age? Well, if we look here at our younger client, if we're looking at Sally, who's 28, and she's a standard plus risk class, for $2 million for 20 years of term at age 28, it's $1,080 a year, or if she was 29, would be $1,120 a year. Not that big of a difference, but if Sally was, say, either 49 or 50, there is a much bigger difference in those premiums. $3,900 versus $4,260. You know, and also when we look at these numbers here, when we're looking at these differences in premiums between a 28-year-old and a 49-year-old, we can see right here how it is so much less expensive to buy the coverage when the clients are younger. Okay, so when you're calling us up and you need to get a quote for insurance, we're going to ask you for your client's date of birth to make sure the quotes are as accurate as possible. We may even adjust your client's birthday when you get a quote from us. It may look a little off. It's not going to be their exact birthday. What we're actually trying to do is we're trying to trick our software to calculate their ages correctly for when a policy is issued, because that's the age the client is going to be assigned when the policy is issued. So we may be, say, 7 months out from their birthday, but we may have to adjust that birthday a little bit just to make sure its software is calculating correctly. All right. So let's change. Look at bands and minimums. Well, for those of you who don't know me, I am a home brewer. I like to brew my own beer. So for my analogy, I wanted to use beer. on the left, we could go out and we could buy a nice bottle of beer, a premium beer, and pay $5. If I go back to my college days, I wasn't so much concerned about the quality of the beer. I wanted quantity. So I would have opted for the case of beer that was $5 a case. So let's see how this translates when we're looking at insurance. Rates are banded for life insurance. Think of them as break points when you're looking at mutual funds for clients. Your clients are going to pay a higher rate of insurance for an insurance policy, higher rate per thousand for a policy that's $100,000 or less. They'll pay a little less if they go up to $250,000, a little less if they go up to $500,000, and they'll pay the lowest rate per thousand at $1 million plus. Also, on top of that rate per thousand, there's also a policy fee that is part of that premium for the client, and that can range anywhere from $50 to $80 a year. So let's say we have Sam here. He's starting out, and he's going to be a CPA, and he wants $240,000 worth of life insurance for the next 20 years because he just bought a house and he has a 20-year mortgage on it. And he went on his own and he found that $240,000 worth of 20-year level term and paid $223 a year. Low premium, not bad. Well, then he listened to his father, who is your client. And Sam then became a client of yours also. And when he became a client of yours, he called, you referred him to us. Now, many of our clients are clients of existing clients already, and that's probably the same for you. But we're looking at Sam. He had a $240,000 20-year term policy that was $223 a year. The first break point with life insurance is at $250,000. So he actually could have got more coverage and paid less of an annual premium. So how much is the max amount of insurance a client can get? Well, it's going to depend on how old the client is. For clients in their 20s to 30, they can generally get up to a maximum of 30 times their annual salary. And you'll see as they get older, that amount drops down. But this is the maximum the insurance company is going to look at, allow them to have. It is possible to get them more than that. We would just need justification from you as to what is the need that and reason why they need that. So when we're looking at annual salary, so if we have Sally, who's a teacher, making $40,000 a year, she can get $1.2 million a year. Sam, who's making $67,000 as a CPA, he can get up to $2 million a year. Well, what is the max amount a spouse, a non-working spouse, can get? Well, for non-working spouse, the rule of thumb with most companies is it's dollar for dollar up to $1 million on the working spouse has. So if Sam has $1 million, Sally can get $1 million. For anything over $1 million for a non-working spouse, they will consider 50% of what the non-working spouse has. So if Sam is going to have $2 million worth of coverage, Sally can get $1 million dollar for dollar, and then for that next $1 million, she can get 50% of what Sam has on that over amount. So Sally will be able to get $1.5 million worth of coverage. Now, more, once again, is available if we're able to outline the need and the excuse for these limits for the insurance company. But what the insurance company is going to be doing is they're going to be looking at a sensibility test. Is it reasonable that the client needs this much insurance? Okay, I have a question here for non-working spouses. Does the insurance company have to be with? Does the insurance have to be with the same insurance company for a non-working spouse? No, it does not. We're often pricing spouses with different insurance companies. It's generally whoever has the lowest price for the client. All right, so Sam and Sally, for now, we're going to assume they're making similar amounts of income, so they each need $2 million of insurance. And that's based on your planning software that you're using, you're calculating they need $2 million worth of insurance. Now, if you're unsure or you just want to do a check, on our website at LLIS.com, we have an insurance calculator that can help you, or if you want to check your own calculations. And we're actually going to go to it here. Give it a second to pull up. And this is our insurance calculator. So here we have Sam. He is 28 years old. And we're going to say he's going to retire at age 67. Rate of return on investments would be conservative, say 3%. Inflation's 3%. Annual after-tax income, $56,000. Keyboard stopping working here. There we go. He has $70,000. Oh, sorry about that. $70,000 of group insurance. Extra zero in there. There we go. And you'll see we come up. He has $10,000. Of assets, and he comes up with a need of about $2.3 million worth of insurance. So it's within our $2 million that we're looking at. So we talked briefly about the underwriting class in one of our opening slides, and I showed you how, as we moved from a preferred plus to a standard class, how the premiums went up. But what the underwriting class the client is going to get is the #1 determinant of how much that premium is going to be for the client. So they're going to look at the family history of the client. So a lot of times when you're sitting across from a client and they may look healthy to you, but they may not be. Most of the time as financial advisors, you don't know about their family history. Insurance companies are concerned if their parents have had heart disease or cancer. You may know if they use tobacco or not. You can look at them and see what their bills are, if they're going to be preferred plus or not. You may not know if they're taking any medications for anything. Foreign travel. Insurance companies are really starting to look at this even more. If your clients are traveling to dangerous countries, they may not issue the policy to them. Or what about dangerous hobbies if your clients like to go scuba diving or skydiving? It's all looked at. And then something that we don't know about until it's done is the lab results, their blood and urine test. And also they're going to look at the medical records of the client. All of this above goes into what's going to determine that underwriting class this client's going to receive. So if we're able to know as much of this up front, we provide a quote, we're able to provide you a more accurate quote. So why 60-second quotes don't work? This is a very popular online quoting site that clients go to. If you notice, we're looking at Sam here, 6 foot, 180 pounds, never used tobacco. If you notice here, he can even select his own rating class on it. He needs $2 million worth of coverage, and we're going to look at 30 years. So when we ran this, these are the top 5 companies that came up. We have Savings Bank Life, L&G is actually Banner, American General, Prudential, Transamerica. Take note of these companies and their names here and their premiums. Savings Bank Life, $1,240. Excuse me. So Sam, 28 years old, $2 million worth of coverage for 30 years. Perfect health. And you know what? Savings Bank Life does have the lowest premium for him. But when he comes to us and we're getting some additional health information, we find out that Sam has high blood pressure and he's taking a medication for it. Well, not every company is going to offer him super preferred if he's taking high blood pressure medication. In fact, you can see about half of the companies, or a little more than half of the companies, said no, you cannot get super preferred if you're taking high blood pressure medication. But Savings Bank Life still does have the lowest premium. We go a little bit farther with gathering his information, and we find out his father died from a heart attack at age 58. A lot of times as a financial advisor, you wouldn't even notice about the parent's history. When we take this into consideration and we look at the companies, nobody will offer him Super Preferred Plus. And there's actually only 2 companies that would offer him Preferred. And actually the cheapest company ends up being Columbus Life. Columbus Life here at $1,087. And if you notice from our original quotes that we showed up there from Quick Quote, Columbus Life was not even one of the companies that was even mentioned. And had your company applied with them and went with Savings Bank Life Insurance, he actually would have been paying $2,280 a year. I have another question here. Is Standard Plus equal to Select? Yes, they're both same class. It just depends on who is the insurance company. Insurance companies call them different. Is there a Select Plus rating? Select Plus, Standard, Standard Plus, they all mean the same thing. They're generally the 3rd best category for an insurance company. Okay. So we do try to get as much information as we can from clients. So what we're going to do is we're going to take a look at our online site for getting a quote request. And this is it. Right off of Low Load Insurance, click on Quote Request. We list them over here, and we're going to actually look at term insurance. First thing we're asking is who their advisor is. We want this so we can copy you on the quotes that we're going to send to the client. We're getting some basic information here, date of birth, height, weight, tobacco use, state they live in, how much coverage they want. Then we get down to the health questions. We ask a fair amount of questions up front. These are like some of the most common ailments that we come across. We also want to know the medications they've taken in the past 5 years, because this may key us into maybe something in the past that they may have or that they currently have. Any hospitalizations or surgeries in the past 10 years. We're getting family history, not just for mother and father, but also siblings. Some insurance companies care about if their siblings have had any health concerns. We also want to know about their lifestyle. Are they going to be traveling out of the country? Are they doing any hazardous sports? And finally, we want to get any kind of history we can get about their motor vehicle records. Is it somebody who has a lead foot and has a lot of speeding tickets? That would impact the rating they would get from an insurance company. All right, so let's change gears a little bit and talk about designing term. Term layering approach. What is this? This is probably one of the best ways to save your clients some money when they need term insurance. What a term layer is, it's looking at multiple policies with different guaranteed term periods to coincide with different life events. You know, when are the kids going to be out of college? When's the mortgage going to be paid off? When are your clients thinking they're going to retire? Now, this may not work for smaller policies because of the policy factors and rate bands, but we do have one carrier that uses one policy factor and the highest bands, even with multiple policies. So we're even able to, a lot of times, save them money with that. So the why? Well, as time goes on, your clients are going to earn more money, they're going to save more money, and they're going to pay down that mortgage. So they may need $2 million today, but as time goes on, that need should go down. So let's take a look at how we're able to save your clients some money with a term layer. So we have Sam, who's 28, preferred non-smoker, needs $2 million worth of coverage. We're looking at a 30-year term, and the cost for that 30-year term is going to be $1,700. Well, we're talking with Sam and the advisor. We decide, well, you know what? We could probably layer this and do $1 million a 30-year term and $1 million a 25-year term. So what this is going to do, it's going to drop the premium down to $1,610. Not a huge savings, $70 a year. But what if we take it the next step and we add Sam and Sally have 2 children now, so their needs are a little bit more spread out. They still need $2 million worth of coverage, but we decide we only need $1 million for the first 15 years and then $500,000 each for 20 and 30 years. So they're going to have $2 million worth of coverage for the first 15 years. Then for the next 20 or the next 5, they'll have $500,000, and in the last 10 years, they'll have $500,000. Excuse me. So when we run these numbers, SBLI actually has the least expensive premium at $1,210. Now we're starting to look at some actual savings from the $1,700 up here. But what's nice with a company called Banner is they will allow us to add a term rider onto a policy. So what we would have would be a base policy of $500,000 a 30-year term, and then we're able to add on a rider of $500,000 a 20-year term and $1 million a 15-year term. The benefit of this with Banner is they're only going to charge one policy factor. So that's the same. We're saving right there over $100 a year in the premium, and you'll see that by doing this option, it saves your clients the most money. And this is the LLIS difference, is when we know you want to layer policies for your clients, we're going to look to see what is the least expensive way to do this for your clients. So let's take a look at turning inefficient assets into effective protection for your clients. Annual renewable term. Let's take a look at the real cost. It's often only for a very short need. Any clients that are looking to buy annual renewable term, they shouldn't need the insurance for any more than 3 years. And one thing that is guaranteed with annual renewable term is that that premium is going to go up. So Sam was approached by an insurance agent 3 years ago before he knew you. And he was told ART was the cheapest. In fact, it was from an insurance company out of Milwaukee, Wisconsin. So Sam was 23 at the time, and he needed $2 million worth of insurance. And it is the least expensive option. Our annual renewable term is the least expensive option, and Sam was convinced it was the best option for him at that time. So here's a schedule of Sam's premiums. First 2 years, $1,250, goes up another $1 for the next 3 years. Then in year 6, it takes a pretty big jump. Well, Sam was smart enough and came to you in the 5th year. He was paying $1,251 a year, but he wasn't sure if that was the best. He knew his premium was going to be jumping up. So what do we have? Well, we have some issues with the current policy. It's a mismatch. He was worried about the premiums increasing. He was still in good health and willing to go through underwriting again. He really needed a 30-year term. He didn't need annual renewable terms. So we looked at a new policy for him, a $2 million 30-year term, and that premium was only $1,700 a year. Now, if we look at this, had Sam come to you in the beginning and we got him this policy at $1,700 a year, it would have saved him quite a bit of money over just the first 8 years. And this premium on the annual durable term just keeps on going up every year. So what did we accomplish? We're able to get Sam a new policy issued at preferred class. He's able to stop premiums from increasing every year. He's locked into that premium for 30 years. We saved Sam a considerable amount of money. And when we're looking at annual renewable term, there's only a handful of companies that even offer it anymore. And whereas we have the universe of almost every company that offers 30-year term. There's a new product that's come out, and it's called Term UL, and it's issued by a company called Protective. They actually call the product Custom Choice UL. It's a non-traditional type of term policy. What it does, it's a permanent policy that's priced like term insurance. So it allows for low initial premiums, just like term insurance, priced just like term insurance. But we're going to specify the level death benefit period, meaning that we're going to guarantee that premium for 10, 15, 20, 25, or 30 years. And even though it is a permanent policy, client still has the ability to convert to a different universal life policy for up to 20 years or up to age 70, whichever comes first. But since this is a permanent policy, one of the nice features of this policy is we can do 1035 exchange from an existing policy into this policy. And by doing that, it reduces the premiums that the client's going to have to pay. Or we can even put enough in to do a single premium term policy. This policy is going to maintain those level premiums. You can maintain the level premiums beyond the initial guaranteed premium. By doing that, the policy will actually start reducing death benefits. So if your client wants to pay that same premium beyond the term period, they can, just their death benefit's going to start decreasing each year. So we're going to use that term UL policy. We're going to segue into what to do with baby policies. And when we say baby policies, these are the policies that mom and dad or the grandparents purchased for a child when they were first born. They're generally whole life policies. They have cash values that they're not going to be touched. It's really a mismatch of insurance for our clients once they're adults. But we have a solution for these policies. So we're going to use Sally in our example here. Sally's dad purchased her a $10,000 whole life policy when she was a baby. Basically, it's a burial policy. But Sally is now 28 years old. Sally's dad, when she became an adult, transferred the ownership to Sally. But Sally actually has a need for more life insurance than this $10,000 policy. What's very typical when we see these policies, they'll have a cash value of around $3,500 with a very low basis. And in our example, we're going to use $700. Well, if Sally was to surrender that policy, she would have a taxable gain in that policy of $2,800. So she'd have to pay taxes on that $2,800. But what she can do is she can do a tax-free 1035 exchange of that full $3,500 into that term UL policy offered by Protective, and we could guarantee her $290,000 of 20-year term. Guaranteed, paid up, doesn't have to pay another premium. This is great, but what Sally really needs is a $2 million worth of coverage for 20 years. Well, that's fine. We could still do that. If Sally went out and bought a $2 million policy of 20-year term on her own, that premium would cost her $906 for just a traditional term policy. Pay the premiums every year, surrender that baby whole life policy, pay the taxes on the gain. Or by doing that tax-free 1035 exchange into the $2 million policy, we can reduce her premiums from $906 down to $700. That lump sum going in is going to reduce those premiums, and she's going to end up paying no taxes because it's a tax-free 1035 exchange. Group term insurance. Is it the cheapest option for your client? There is no doubt about it that group insurance is very inexpensive, especially at age 28. But you got to think long term. How much is your client going to pay for that group insurance over their life? Also, you usually can't get the amount that you really need with group insurance. Generally, you're capped at 2 to 2.5 times your salary. Also, that insurance is not portable, that group insurance. You can't take it with you when you change jobs. Or if you want to take it with you, you got to convert it to a whole life policy. That's very expensive. And how many of us have the same job when we were 28 years old? I know I don't. I'm in a actually completely different field than when I was 28 years old. But when we're looking at group term insurance, the first $50,000 are provided tax-free when it's paid by the employer. If the employer is going to pay for more than $50,000 worth of insurance for the client, it's going to be taxable to them at Table I. There is a cost for supplemental term insurance, and with group term insurance, that cost increases every 5 years. So whenever your client has an age that ends in 0 or 5, they're going to see an increase in premiums. And those policies, group term, it's guaranteed issue. When you elect it, you're guaranteed to get it. Traditional term policy, you do have to go through underwriting. And that group term, it's very cheap for those young ages, but those prices jump. All right. So let's take a look at Sam. He's looking to get the $250,000 worth of coverage. You know, he was thinking about he was getting this back when he wanted to replace his mortgage. And when he was 28 years old, his premium was only $195 a year. But we can see as he gets older, his premium goes up each year. I mean, look when he's 45. It's $744 a year. If Sam had purchased a 30-year level term when he was 28 years old for $250,000, it was only $267. And you remember I said when you're looking at group term insurance, you got to think long term. If Sam stays with the group insurance over the 30 years, he will have paid almost $24,000. Where with a 30-year term policy, he would have paid just a little over $8,000 over those 30 years. And the individual term is portable. He's not limited to staying with his group. So let's take a look at the term riders. All right, the first rider we're going to look at, there's a couple of term riders that are available. First one we're going to look at is waiver of premium. It allows what the waiver of premium rider does, it allows your client to suspend premiums while a policy stays in force if they're unable to work due to illness or injury. Makes a lot of sense. If I become disabled, I want my insurance premiums paid, but the definitions for disability, think of Social Security. That's how restrictive they are on insurance policies. You have to be totally disabled. Typically, we don't recommend waiver of premium for clients on life insurance policies. And let me show you why. So if you look at Sam, who's got the $2 million term policy, he's going to pay $1,700 a year. If we add waiver of premium to the policy, it increases his annual premium up to $1,820. So basically, he's paying $120 a year to cover an expense of $1,700. And what that basically translates into, for every $1 in disability premium he pays, it's going to give him $14.17 of insurance. Now, if your client's really concerned about that, he should probably have an actual disability policy that's going to cover more than just his insurance premium. So Sam could go out and buy a disability policy with a 90-day elimination period, benefits up to age 65, residual rider, and an annual benefit that would pay him $50,400 a year, he'd pay a premium of $878, so a little bit more than what we're paying with our waiver of premium on our term policy. But for every $1 of disability premium he pays, he's getting $57 worth of insurance for that. So out of this $50,400 that he's going to receive in annual benefits, and he doesn't have to be totally disabled according to Social Security, he can use that to pay his insurance premium. And then he's free to do whatever he needs with the rest of that money. As I said before, our May webinar is going to be on disability for our clients. Please tune into that webinar, and Kathy will go into much more detail on disability insurance. Accelerated death benefit riders that are on policies. What they do is they allow your client to access to living benefits in the event of terminal illness, chronic illness, or specific medical conditions. These are provided at no cost to your clients. They're part of just about every policy out there, and they're generally available in payments or lump sums to the client. Some companies offer a predictable benefit where they'll give you 40% of that death benefit up front. Others are going to use a formula. If you have a client that runs into that situation, contact us, and we'll help them get the benefits from their policy. Children's term rider. Not too bad of a rider, actually. It's generally attached to the parent's policy. It's generally available in $1,000 increments of insurance, and you can generally buy up to about $20,000 worth of coverage. Most common is $10,000. It's a burial policy for children. And, for example, with Savings Bank Life Insurance, it adds $54 to the policy each year. But you don't have to pay $54 for each kid. It covers all eligible children that the client has. Doesn't matter if the client has one child or 8 children. It's going to provide $10,000 worth of benefits for that $54 a year. Now, coverage is going to last until that child turns 24 or the parents turn 65. If the policy lapses, that rider goes away, or the client can terminate that rider at any time. But what's nice with those child's term riders is that they can be converted on any policy anniversary for the same amount. So your clients can convert it to a $10,000 universal life policy, or what's actually more common is when the child reaches age 75 or the parents reach age 65, you can generally convert it up to 5 times the amount. So for that $10,000, which is the most common, they can convert it up to a $50,000 policy. Can a kids rider be added to a policy already issued? No, it cannot. They need to be selected at the time when the policies are issued. That was a question that was submitted. All right, so let's wrap up the 20s here. So we looked at the basics of term. Your client's biggest asset is themselves. We looked at how buying the insurance when they're young can save them some money. We looked at bands and minimums with term insurance. We looked at the underwriting classes. We designed term that's going to suit each client. We looked at term layering in Sam's case. We looked at turning inefficient assets into effective protection for your clients with annual renewable term UL, baby policies. We looked at group term insurance, why it's not always the least expensive option. And we looked at some term riders that are available on these policies. Well, something new we're going to start doing with our webinars. We're going to add at the end of every webinar a topic called Did You Know? There's been some changes going on in the insurance industry lately. First, if you haven't seen the announcements yet, LLIS has become an exclusive NAFA Genesis sponsor for February 1st, and if you're not familiar with the Genesis group is within NAFA, it's for advisors that are under the age of 33, and it's to encourage more of them to join NAFA and give them an area where they can be around their peers in their same age group. We'll be at the NASA Spring Conference in May. Mark is actually going to lead a session on Wednesday, Insurance Strategies for the New Normal. Please stop by, visit our booth. And NASA Genesis members, we will be doing a social Wednesday night at the spring meeting for you guys. So what's the latest in long-term care with Genworth? Genworth seems to be having the most changes going on right now. There's some changes coming up in April. You may have seen the announcement from us. You may have seen it written up in articles. But in case you haven't, rates are going to be going to gender-based with Genworth. So basically what does that mean is single females are going to be affected the most. Females are going to see, we're told, about a 40% increase in the premiums for long-term care insurance. There's also going to be some underwriting changes going on with Genworth. They're going to start requiring paramed exams for anybody who's applying for long-term care insurance. They're also going to take a look at family history of those clients and some other things. They're lowering their maximum issue age from 79 down to 75. What's good is they're going to be adding a 4% compound inflation option. Which is good. It's given us some more options for clients when we're looking at ways to reduce the premiums from the 5% compound. And they're going to be suspending all sales in California until a new product is approved. And in fact, that deadline, I believe, has come on us already, or it's about ready to happen in the next day or two. What we've noticed with the long-term care industry, once one company takes a step to do something like this, we generally see the other company following suit very quickly. We'll have an email out this week, maybe next week, with more information once Genworth gives us more details of exactly what's going on, what states are affected, and we will continue to pass that on to all of the advisors. All right, top 10 things that make LLIS different. For those of you who have not worked with us in the past, we are not your competition. We only provide insurance. We provide insurance education through monthly webinars that you're on right now. We do our Insurance Academy in February for fee-only financial advisors. We are a sponsor of the National Fee-Only Financial Planning Organizations like NAFA, Genesis Group, Air Planning, Alliance of Cambridge. You are our only client. We don't advertise out to the general public. We are here to service you and your clients. We save you time. We're a one-stop place to go for your clients' insurance needs. We save your clients money by always recommending what is best for them. We do the pre-underwriting, which is part of some of what we talk about. We try to avoid surprises. We don't like the surprises. You don't like the surprises, nor do your clients like them. We have product specialists in all of our products, life insurance, disability, long-term care, and annuities. And when your clients get life insurance through us, we keep you in the, when your clients are getting life insurance from us, we keep you in the loop with our AIM system. You don't need to call us and ask us, where's my client in this, where they are in the underwriting process. We keep you updated through our AIM system so you know what is going on at all times with your clients. And finally, once your clients have their policies and their policies are in place, our service doesn't stop there. Every year when your client's annual policy fees are coming due, we're going to send you and the client an email about a month before that premium's due to let you know that it's coming due. We've had a lot of clients who have moved. They wouldn't have gotten their premium notice from the insurance companies. This has been a huge success in helping keeping policies in force. All right, let's see. I've got another question here. How many years of rankings are important to look at? We only have the ability to look at what the financial ratings are as an insurance company today. We depend on the rating agencies to keep tabs on the insurance companies. We are able to tell if they're on a watch list, whether it's going to, if they're looking for negative or looking to improve their ratings, but we do keep abreast of all of that. All right, so what we're going to do now is if you have any questions you'd like to ask, if you raise your hand, we'll be able to unmute your line and answer any questions that you have. I have a question here that was submitted about underwriting. What about careers such as like police officers, firemen? Generally, they're not an issue. They're not looked at adversely unless the client is like on the SWAT team or they're an undercover officer dealing with drug enforcement. But if they're a normal police officer, a normal firefighter, it is not an issue. And all right, if nobody has any other questions, I don't see anybody raising their hands. Thank you for tuning in today. My email address is there if you have any questions, and thank you for joining today.